Andreas Steno, welcome to Real Vision. I believe this is your first visit to us.
It is, yeah.
Excellent. And you are the joint head of macro strategy at Nordea, where I believe you're a lifer at Nordea. Could you maybe just give a little bit of background for our viewers as to where you've come from and how you got into this position in this world?
Well, I consider myself like the Mr. Nordea. I've never worked anywhere else. So I've been in sort of the macro strategy part of the business forever, at least forever in my life. So I've been there since I was 20 years old. I started there as a junior, basically worked full-time throughout my studies, etc. So it's been kind of my life to just be a macro strategist in Nordea. It sounds a little bit boring, but it's
well,
not.
No, I think we love macro here. Yeah. I mean, because it's the key thing. And in fact, obviously, you're here to talk exactly about that. I think, there's this fascinating world of Europe, fascinating world of yields. And there's this lovely chart that you've produced, which is, it shows mainly it's the Bund yield versus QE 1, 2, 3 and ECB QE plus European inflation expectations. And there's quite a distinct pattern. And maybe you could explain that pattern, what it is, and maybe why you think that's come about.
The thing is that the vast bulk of the drop we've seen in long bond yields in Europe has occurred outside of QE programs. So outside of the three QE programs from the Fed and outside of the QE program from the ECB. So the interesting thing is that we've actually had this pattern that bond yields tend to pick up while central banks are purchasing bonds.
So it's
it sounds counterintuitive.
Yes.
And I think the reason is that central banks have managed to artificially push up inflation expectation, growth expectations while purchasing. So counterintuitively, while they purchase bonds, they push yields higher. It makes sense from a sort of Friedman perspective, but it doesn't make sense from a supply-demand perspective, I guess.
I suppose it could be because the world was so well and truly broken in 2008 that maybe bond yields would have collapsed even lower if they hadn't come in with QE. And QE creates the illusion of growth because it's very, very minimal growth. But when they stop, the emperor has no clothes. They stop doing it and you go, actually, you know what? There is no growth. And maybe those yields collapse with it at the same time.
Yeah, I feel pretty sure that 10-year Treasury yields, they would have gone to zero if the Fed didn't start the QE program after the great financial crisis. So they kind of saved the bond market in a sense. And it's kind of interesting that they've actually managed to do that exact same thing each of the 3 times they've conducted QE. So that's also why I have the view right now, if you want to bet on a curve steepener, then you need to wait for the Fed to launch QE4. That's it.
And so here we are sitting on the Friday after the ECB launched QE Eternity, forever and ever. And do you think that in itself is going to help bund yields? Because bund yields obviously recently hit minus 75. They've recovered quite a lot. I think they're minus 50, under minus 50 now. Do you think that QE Eternity is going to be sufficient to properly lift bund yields and properly lift inflation expectations?
Probably not. If we look to Japan, it hasn't really been a success with QE Eternity. So I'm not an optimist on behalf of the Eurozone in that regards. I would be much more optimistic if it was the Fed that launched a new QE program. The point is that there is no scarcity of euros out there, but there's a scarcity of dollars. So it's much more important if we get a dollar liquidity injection compared to a euro liquidity injection. No one needs a euro liquidity injection. No one wants the euros.
And what is the issue with, because we constantly hear this, the euro-dollar market is tight. There is this dollar funding issue. There are fewer dollars in the system because the US is no longer importing as much oil. Global growth maybe has peaked, and global trade maybe has peaked. And obviously the corporates in the US brought quite a few dollars back with those tax changes. Is there an issue around funding at the moment, this euro-dollar market? Is there a problem with the dollars?
I think there is a growing problem, and it will probably emerge as an even bigger problem 3 months from now. We know that the US Treasury will withdraw further dollars from the commercial banking system as they will pile up the Treasury account at the Fed again. So that's an important thing to watch over the next 3 months because they will basically take out dollars when they pile up their own cash account at the Fed again.
And could you explain that dynamic? This is to do with the debt ceiling.
Yes, exactly. Yeah. When the debt ceiling was suspended, the Treasury basically allowed itself to issue again. Before that, they had taken the cash account all the way down to zero, more or less. So they are not allowed to hold a lot of liquidity ahead of a debt ceiling deadline, simply due to the fact that they don't want to give politicians too good incentives to just drag out the discussion forever. And once we are on the other side of this debt ceiling suspension deal, the US Treasury can issue bills again at a higher pace and then rebuild this cash buffer at the Fed. And when they do so, they take that exact amount of liquidity back from the commercial banking system. And that's an issue for funding markets, I would say.
And where do we see that most acutely? I mean, what should people be looking at? I've always looked at things like FRA OIS.
Yeah.
Is that this is the forward rate agreements versus the overnight interest swaps? Is that a good place to watch? Because it's sort of breaking out, but it's not. I mean, it's still quite low compared to the last two peaks.
Yeah, that's definitely the one to watch, the dollar LIBOR OIS, and it is priced to get higher over the next 3 months. But I would also watch out for risk appetite in general. If funding becomes a problem in general, then you could see spillovers to credit space, you could see spillovers to equity space, basically. This is a matter of risk appetite as well.
And bringing that around, because in this world where we're so interconnected, we sort of look at, there's funding issues over there, there's dollar over here, there's this bund yields falling. All this actually, there's this kind of quite dangerous and toxic environment for European banks as a whole.
Yeah.
We've always talked about yield curve flattening and yields being depressed, being bad for earnings. And we've had this incredible collapse in bund yields and a flattening of the yield curve in an environment where, yes, growth has been a problem, particularly for Germany, but we're not in a crisis mode right now. But do you see that this funding is going to be an issue for European banks? Are European banks struggling to get enough dollars?
It could be an issue for European banks, but I would expect European banks to struggle more due to the flat yield curve in Europe, basically. And I would have said after the ECB meeting yesterday that it was a success if they managed to steepen the yield curve. They did not. Actually, the opposite happened. They flattened it due to a very, very poorly designed tiering system, in my view. So actually, they only did matters worse for the European banks. The struggles will continue, in my view, given that the yield curve did nothing but flattening yesterday.
And the tiering, what was the tiering that they announced, or how is that going to work for these banks?
Well, they announced an exemption for all banks in the Eurozone, 6 times their marginal reserve requirement. So that's basically the buffer that a bank needs to hold at the ECB. So 6 times that amount will be exempted from the negative deposit rate at the ECB. The issue is that all of the deposits, they are parked in German, French, Dutch, and Finnish banks. So when Italian banks are exempted 6 times their marginal reserve requirements, they basically allow the Italian banks to place all of their excess liquidity at zero at the ECB because they don't have a lot of excess liquidity. And that could lead to a spike in repo rates in Southern Europe. So maybe there is actually a risk of an unintentional tightening of financial conditions in Southern Europe due to this tiering system. One size doesn't fit all in the Eurozone.
So if we're looking for risks in Europe, I think, myself included, I've been focused on sort of the German manufacturing slowdown based on China, etc. But do you see the greater risk here actually still being the peripheral, as it were, or the kind of the Mediterranean countries and their banking system, or is this now kind of endemic across the whole thing? I mean, everyone's got these massive kind of lots of liabilities, but they're not getting any income. Is this the whole of Europe, or is it still we've got to focus on Italy and places like that?
It's kind of upside down right now. I think Germany is quite clearly in a recession at the moment. Sweden is in a recession, so the manufacturing countries are in a recession. And it's pretty much upside down compared to 2011-12. But the issue is that a lot of the Southern European economies, they are so interlinked into the German economy that I would expect German moves to spill over to Southern Europe with a time lag. So we are yet to see that in a big scale, but I think Southern Europe is next up in this slowdown. It's kind of inevitable.
Focusing on Germany, do you see Germany's slowdown as, I mean, I think we've had 4 or 5 months now where its manufacturing PMI has been sub 45, so in that kind of recessionary territory. Do you feel that there is still more potential downside, or do you think that there are, I hate the word green shoots, but there might be a sort of bottoming out in that kind of, that peak fear of German manufacturing? How do you see Germany in this?
We talked about green shoots for, I think it was 1 month during the spring, and it was just shut down almost immediately by Trump. But I think if we look at German figures, I would expect them to bottom out maybe during the first half of next year. I would actually have expected them to bottom out already, and this is what makes me a little bit scared. If you look at the stimulus from lower interest rates, a weaker euro, you should have expected that stimulus to kind of get things going in Europe. So maybe rates are not low enough. the concept of a neutral rate. I mean, the rate that is neutral to the economic momentum of an economy. If rates were currently low enough to really spark momentum in the German economy, why aren't we seeing it? I mean, maybe we need to get even lower before we really see a pickup in momentum. So I'm not an optimist on the German economy's behalf, at least not for the next 6 months.
So rock and a hard place, because the sort of transmission mechanism for growth has generally been the banking system, and that's obviously slowing down or having problems because of the yield curve. But Europe is an exporting bloc, so therefore getting the euro lower. And they want to get the euro lower, I'm guessing, but without being seen to obviously get the euro lower, which is pretty hard to do. Get the euro lower, which helps the exporters, but in the things that get the euro lower often will be things that flatten the yield curve and maybe even dampen yields, which means the banks get screwed. Which one should they really focus on? And can they? I mean, is this the problem with Europe, is that damned if you do, damned if you don't?
Yeah, it is. I would actually, if I were a member of the ECB, I would do my utmost to try and re-steepen the European yield curve to sort of help out the banking sector again. And that would be good news for the euro, as you say. So I'm not in a position where I would be scared of a slightly stronger euro. If you actually manage to re-steepen the yield curve, I think that would be better news for the Eurozone as a whole compared to the situation we're stuck in right now.
What would be the impact of that on the kind of the Italian banks? Everyone worries that if yields go higher, then all the indebted, particularly the Italian banks, etc., they can't withstand that expectation. We had that little sort of fear factor at the beginning of 2018. And Italy, I think currently their 10-year yields are sub 100 basis points. They haven't quite tightened to Germany yet, as they had a couple of years ago. But if you want that steeper yield curve, doesn't that then become a problem for the sovereign? Or is there a buffer where you say 2.5% is where it becomes a problem?
I mean, you can try and steepen the yield curve from the front by bringing the front even lower than what we see right now. And I think that's in the plans of Christine Lagarde, the next ECB president, to take the front much, much lower than what we see right now. I wouldn't be surprised to see the policy rate below minus 1%. I mean, that would be her toolkit to get the steeper yield curve. So it's not necessarily a problem in the long end. You need to steepen the yield curve from the front, in my view.
And with Christine Lagarde, I mean, that's kind of the expectation is she's going to bring the fiscal side of it as well.
Yeah.
Is there anything out there which actually says that going to minus 100 is a good idea? It seems to me that these people sort of, they sort of say, well, the reason why this hasn't worked so far is we haven't done it in enough size or we haven't been aggressive enough. It's failed because, well, we need to be minus 100, we need to do more. But what are they basing their views on?
Well, I think the ECB is sort of fighting itself in a sense, given that they impose more and more regulation on banks in the Eurozone while they try to force the credit cycle up and running again via the monetary policy tools. So they're fighting against themselves. On one hand, they try to limit the activity via regulation, or I don't know whether they directly try to limit the activity, but they do via the regulation. And on the other hand, they try to force the credit cycle back up again via the monetary policy tools. So in a sense, they're fighting against themselves. If they actually allowed both channels to work with the Eurozone momentum, then I think we could get out of this mess.
And what sort of time frame would that be? Because obviously as investors, people are thinking, well, okay, when do I want to go long banks? I mean, banks having a nice bounce as we speak the day after the ECB, but we've seen bounces before they don't have any legs. We've seen back up in yields and they sort of peter out just when we get excited by them. Everyone's waiting for this move. What sort of time frame and how long can we visit these? Because these tend to last for no more than 6 months when we get a really good bounce.
Yeah, I wouldn't go really long banks in my portfolio unless the Fed joined the QE party. I think that's much more important for the reflationary environment if the Fed launched QE4 again. So I think it's only sort of a short-term story, if anything, this QE story from the ECB. I don't think it's a lasting story at all.
And the Fed's not going to do QE anytime soon, are they? They're going to focus on rates first.
Yeah, they will probably focus on rates first, but due to the liquidity issues that I mentioned in terms of dollar funding markets, I wouldn't be too surprised to see them launch a QE4 program by end this year. I know it's not the consensus view by now, but I think they will simply have to add some dollar liquidity to the market in one way or the other. And I think the easiest way to communicate it is just to launch a soft QE4. Why not?
And that QE will be kind of commensurate with that drawdown that the Treasury will need to do from the markets to the Treasury funding. And they go, okay, well, we're putting 250 billion down or whatever the number is. We need QE at least at that sort of size.
Yeah.
And what have you seen in things like velocity? Because whenever people do QE, it always seems, I mean, you kind of do the balance sheet one way and velocities the other way. And actually, when the balance sheet of the combined banks started to roll over, as we got 18 months ago, velocity started to try and pick up. But if they go back to QE, doesn't that just mean velocity falls, which means that negative productivity, negative growth prospects? So actually, we're just hammering another nail in the coffin of low growth?
Yeah, it probably will mean that. But I think there are different time horizons in this story. The first time horizon is the positive reflationary story, sort of the artificial build-up of expectations again. So it's more a build-up of expectations than actual reflation. So if they launch this soft QE4, I think we will see a build-up of expectations, but I don't think it will materialize down the road. So that's kind of the difference in time horizons. First move up. First move is a reflationary move, but then the second move is down again.
So the last 10 years, would you characterize the last 10 years as really being central banks having kind of destroyed the normal business cycle and replaced it just with a liquidity cycle, and liquidity in, markets do okay, stop liquidity, markets do badly? Is that kind of where we are?
I think that's pretty fair. If you use excess liquidity, so central bank liquidity on a global scale as an asset allocation variable, then you've been pretty much on top of things since 2008. Every time liquidity is ample, markets rally, and vice versa when liquidity is not ample. So I think that's basically where we are now, a liquidity-driven cycle. There's no real business cycle left, in a sense.
Within Europe, what spots would you look for? Because when I kind of look at Europe, I think, okay, I want to be negative on Europe, and I sort of have from the banking perspective. Where would you play kind of Europe? Because is Europe headed towards a catastrophe? And what I mean by catastrophe, forgetting the existential theory around the euro, is there any way Europe can get out of this? We talked about stuff, but it sounds like it's a 6-month buffer, and we need the Fed. And actually, the Fed might just be doing the liquidity in, liquidity out anyway. And within Europe, which are the pockets you look at? Would you look at certain banks, certain sectors? How would you kind of play that, and what would you be sort of looking at as someone who's trying to invest or remove money out of Europe?
I would definitely look for sectors that are directly exposed to the reflationary environment if the Fed launched this soft QE4. But again, a short-term story. But so those kind of sectors could be the manufacturing sectors, because they are at such a bottom point right now that things can almost only get better, right? So such sectors, such as the German manufacturing sector, would probably fare better if the Fed started to reflate the whole storyline a little bit. But again, I'm not really an optimist if we go 5 years ahead. For example, let's take the concept of quantitative tightening that the Fed managed to do a little bit of during 2018. If we were to discuss such a thing in Europe, I think that Italian markets, they would implode more or less directly after that message was announced. I don't think it's a feasible scenario to think that the ECB can ever offload any of the Italian debt that they have on their balance sheet, because markets will get scared straight away. Just this little quantitative tightening process in the US almost talked the market into a recession Q4 last year. So think of a scenario in Europe in which the ECB starts to offload Italian bonds. I wouldn't be too comfortable about such a scenario, at least.
It sounds like there's this kind of amplification effect where, I mean, you talked about there was a little bit of QT and a little bit of growth momentum lost at the end of last year. And then we got a 20% collapse on the S&P, which, given where the ISM was at the time, was actually a very big move, considering that the growth was theoretically okay at the time. Is that a part of the problem for the global system now, which is that small changes in funding, small changes in growth momentum creates outsized moves in some of these kind of overly built-up assets?
Yeah. I think it's quite simple that when central banks, they take up a big portion of the inner part of the risk curve. So they basically purchased a lot of the most safe assets, government bonds, both in the US and in the Eurozone. It naturally pushes private investors further out the risk curve. So if we have govies in the US and Germany at the inner part, and we have high yields in Botswana out here, then you've basically pushed private investors all the way that way out. And if you start to withdraw liquidity in here, then you also tell private investors to move that way in again. And then you start by seeing countries in the emerging markets imploding. Next up is probably credit equity space, and that was the exact sort of chain of events we saw during 2018. First Turkey, Argentina, stuff like that imploded, and then came the sell-off in Q4 in S&P 500. withdrawing money in here means that you will automatically draw back private investors inwards on the risk curve, in my view.
Big question for a lot of investors then is, can the central banks always be one step ahead? And the pushback on that is always 2000 to 2003, the Fed cut rates, market still fell. 2007, 2009, the same thing. But we've seen quite a few times now when it looks like things are getting very bad, and we saw that 2015-16, end of last year.
Yeah.
We've seen a relent, we've seen liquidity, or we've seen something from a central bank, and the old framework returns of falling volatility, GDPs converging, but risk assets are supported. Can central banks do this indefinitely, and indefinitely being maybe my investing lifetime of another 10, 15 years, or will this fail sooner than we think? And what is that? Because they'll be watching the funding issues that we worry about.
I think there's a pretty sad scenario that is growing in probability, and that is a prolonged sideways move in S&P 500 and DAX, because we've taken sort of the large portion of thrust from lower interest rates, and it is tricky to foresee another big move lower in interest rates right around the corner. So that is not going to be supportive of valuations in equity markets. And then we're left with sort of the discounting of a slowing growth structurally over time. And that's not really a positive equity story. It's more a story of flatlining equity returns, something that looks quite Nikkei-ish. We had like 30 years of flatlining equity returns, I guess. I think something like that could be up.
And will there be rotations within this? It sounds like this is going to be the sort of story where we have government-sponsored 1% growth, 2% growth in the developed world, and we kind of just get used to that. Equities will have drops and rebounds. Maybe there'll be more of these 20% drops. But will it be about rotations, or will it just be about, well, okay, our back's covered, we just carry on piling into those stocks which are now expensive and ignoring those stocks which are cheap and hoping?
Yeah, but don't you think that investors will seek even further out the risk curve in such case? There is a reason why Burgundy wine and art and all that stuff is all-time expensive. I don't think it's necessarily a positive story for equity markets. I think you need to look even further out the risk curve for such a story.
So we're just going to see a lot of longer-dated issuance in debt markets, in corporate bond markets and stuff like that.
Yeah.
Is there going to be the instability? Because we always worry. I mean, the biggest worry a lot of people have is that the corporate bond market looks too big for the underlying economy. In particular, everyone focuses on the triple Bs, junk as well, but triple Bs really are junk. But can we just keep on going?
I think, isn't it the exact market that the central banks need to focus on now? They need to save that market. I mean, a larger and larger portion of debt has moved to that sector, to the corporate bond sector. So I guess it has to be sort of on top of the mind in the ECB, within the Fed, to ensure that that market doesn't implode. And I mean, they could easily buy more of that. Why not? We haven't seen that much buying in corporate space yet from central banks. And I think we could easily imagine that both in the US and here in Europe.
So high yield, although it's massively risky, maybe European high yield is something which we should continue to buy.
It could be a good buy, yeah. And
what does it mean for currencies? Because we've seen this, I mentioned earlier, the convergence of volatility, convergence of returns on assets to these low single digits, GDP, etc. Will we ever get currencies breaking out? Because we had this very low period of FX volatility, and the dollar's still in this range versus the euro, and is still never quite breaking out against the euro. Where does the euro go on this? Because it sounds like we just can probably continue a range.
I'm probably slightly contrarian in my view on the euro, because I actually think this is a positive long-term euro story, like it's been for the Japanese yen. If the ECB QE is an eternal thing, I think it is, then you should expect portfolio flows from the Eurozone into emerging markets basically over the next 5-10 years. And every time that there is a local shock, then we will see repatriation of funds from emerging markets back to the Eurozone. I also think we've seen that a couple of times this year where we've had large moves in euro versus EM currencies as a result of money being repatriated back to Europe from emerging market positions. So I actually think that over time, the more shocks we would get to the economy, the better the euro will fare.
So would the flows therefore be, the flows are out, pressure on the euro, but the asymmetric move is euro up? So it kind of sounds like you've really got to trade that, because the euro is going to have its big spring back when you have a real problem. Yeah. But isn't that also the time when you go, well, that's an existential threat for Europe because it probably means the banks are blowing? I mean, it's always that hard, isn't it? Because these huge flows have gone out into other assets. Will they come back? Will people go, actually, these European assets look terrible as well. I'm maybe just better off going from my emerging markets into dollar assets for safety. Maybe would that potentially happen?
I think it's a cultural thing. A client once asked me, why is the yen gaining when there's a nuclear bomb flying over Japan? I think that's kind of counterintuitive that people actually drag back their money when there's an issue at home. But I think, to my knowledge of European culture, I think something like that is very clearly within something like that. I could imagine that once these structural issues, they start to hit the Eurozone, then you would actually rather want your money parked very close to yourself rather than outside in the world. So why not? I mean, I think that could easily happen.
There's been this incredible distortion within Europe, and real estate is one of these things where real estate and mortgages and Danish mortgages, and you get paid to take out a mortgage.
I don't get paid because I rent my apartment. I think that's quite stupid. But,
well, maybe now's the time to go into it, because it sounds like if we've got QE infinity and we just had another 10 basis point depot cut and this world's going to continue, all the people, all the countries which are sort of semi-linked to the euro or linked, I think we had the response from Denmark as well.
Yeah,
so are we just going to continue to see these sort of little bubbles of property? I mean, the Berlin property bubble, Danish, is that going to continue as well? Is that where people should be putting their money, real assets?
I don't really see why we should expect property markets in Scandinavia, for example, to implode, because with rates at current levels, you could easily afford your mortgage when you're laid off. I mean, it's not an issue. You don't pay anything. You're actually paid. The old cyclical property market is probably a dead story, given that if we get a big surge in unemployment, it's not really an issue for the property market any longer, unless we get a spike in money market fixings. But I don't really think that's the case as long as we have as much liquidity as we have right now in the system. So property markets are probably another good buy.
Yeah, I mean, I think it's kind of scary, isn't it? Because we always worry about these bubbles, but these bubbles are almost baked in the cake because of where our expectation of interest rates in Europe probably have to be given QE infinity. So there's no such thing as a safe bet, but it kind of makes logical sense. Just moving away from Denmark, but into Scandinavia, Sweden in particular, which has obviously been one of the great bellwether manufacturing economies. Do you see anything there? Because the Swedish krona started moving down versus the dollar ahead of the big worries that we got on German manufacturing. What are you currently seeing out of Scandinavia, and particularly out of Sweden? Is Sweden still saying there is a big problem here, or do you see that it's getting better?
I think the Swedish krona is a fantastic bellwether for the global environment. And actually, I think the Swedish krona managed to forecast both the dot-com bubble and also the great financial crisis. When the Swedish krona weakens fast, it's a warning signal because the Swedish economy is maybe the most open economy in the world, outside of South Korea maybe. So it is extremely export-oriented, and therefore the Swedish krona reacts very swiftly to changes in the global environment. And right now we are still on a quite clear weakening path for the Swedish krona, so I consider that a warning signal, basically.
So the current move that we're seeing, the dollar's having a bit of weakness post ECB and currency having a bounce, but that's probably an opportunity to go short things like Swedish krona and these other kind of big global currencies.
Yeah, I mean, we couldn't be more negative on Sweden than what we are right now, Nordea, I guess. We are so far from the projections from the Swedish Riksbank. We basically expect a light recession around the corner. We expect weaker Swedish kronas. We expect weaker Swedish inflation and all that. So, I mean, we are so far from the Swedish Riksbank, and they still intend on hiking. We're not sure why, to be very honest. And I think our colleagues in other Scandinavian banks, they're also puzzled by the Swedish Riksbank at the moment. It's like it's turned pro-cyclical, sadly.
With central banks as well, we talked about Christine Lagarde earlier, potentially going even more negative, deeper into negative territory. Potentially they're watching Switzerland, which are leading this charge to lower and lower. And so far, Switzerland hasn't imploded. What would it be that these central bankers suddenly go, actually, you know what, this really doesn't work? Or will they always take the view that we just got to do more of it?
I think if you look at, for example, the research that Christine Lagarde put her name on within the IMF, they've even started talking about whether you could create a system in which physical cash depreciates versus digital cash over time to ensure that people don't make bank runs when you take the deposit rate into even lower negative territory. So I think they are still sort of looking for ideas on how to actually continue down the road where we are at the moment. And I don't really see any big turnarounds within the academia in central banks. I still think that they're looking for reasons to go even deeper into negative territory. So I wouldn't be too surprised to see the trend continuing.
And that one of those trends as well has been this great inequality, generational, but also within countries, geographical as well. I mean, is this going to just continue to accentuate that inequality? And how I mean, Europe, US, how are people going to deal with that? I mean, how is that going to play out?
I think it's important to note that this is a matter of wealth inequality more than a matter of income inequality. Income inequality is not an issue in my view, but wealth inequality is a big issue. And I think my generation will take all the wrong decisions in response to this wealth inequality. I first of all expect wealth taxation to be upped materially over the Eurozone. I expect a big move to the left politically amongst my generation. And then I expect the public sector to play an even bigger role in the overall economy as a response to this. Up taxation on the wealthy and spend more. I think that would be the response to this. It's kind of inevitable because if my generation, those from my generation who didn't join the asset party, most of us haven't, we're kind of stuck decades behind the curve in a sense because we're not able to enter the property market. And we're not basically able to live the lives of our parents because we're not able to enter the markets that they were. And I think that will prompt a big policy response in the Western democracies.
It's always been, maybe this is one of those great generalizations not backed up necessarily by lots of empirical evidence, but more government generally means lower growth.
Yes.
I mean, the more governments you have, we just know that governments are not very efficient at allocating capital. So that's going to exacerbate Europe's problems, isn't it? Not improve them. Oh, but you're talking probably over a generational time frame.
It's definitely not a solution to just tax the wealthy more and distribute more. But I think it's inevitable as a response to the growing wealth inequality. So there's certainly a difference between what should be done and what will be done here.
Can this be done at the euro level, or is this going to be individual countries slowly moving? Because if it's individual countries, they move to the left, probably someone else will move to the right, and eventually it's going to take a long time before sufficient member countries within the Eurozone, 28 of them, become sufficiently of one side of the boat to all go, we agree with this. I know they've got Christine Lagarde, who's a great politician and lawyer, but it sounds like to actually get to these sorts of moves, it will take a long time. There's going to be a whole bunch of iterations.
We already have the signs there. In my view, we have Matteo Salvini very close to getting a majority in Italian politics. He's definitely in favor of spending more, keeping interest rates low, and also maybe taxing the wealthiest part of the population. So we have the signs there already. And even though the ECB will never admit it, I actually think that they could get a helping hand if Matteo Salvini became the prime minister in Italy, if Marine Le Pen won the election in France, and if Alternative für Deutschland won the election in Germany. I'm not supporting those parties, but they will actually do something to bring up inflation. And that's exactly what the ECB needs. I don't think there are parties with a more inflationary policy than the right-wing parties.
In some ways, the parties in extremis at sort of both ends are surprisingly similar to each other in some of their policies. So whether it's hard left or hard right, they all kind of want to come out of austerity.
It's the same thing now.
And so they're going to kind of move into that spending space. So if I was a European investor, I mean, should I be looking at the central banks or the combined efforts of the governments and the central banks together, spending more money by just giving everyone a cash voucher, or are they going to focus on infrastructure so I can actually say, well, actually, that's the area I want to invest in? What people should be looking at a long-term view?
First step is definitely infrastructure. You've seen how Matteo Salvini in Italy blamed the European Union for the collapse in the bridge in Italy. So I think that's definitely first step. Infrastructure, infrastructure, infrastructure. Next step would probably be to redistribute a lot of the asset wealth from the wealthiest to the bottom of the society. So that's basically classic consumption. So I would also look for sectors that are linked to classic consumption. Because if you have a big positive wealth effect in the top of the society, you don't really see a big increase in consumption patterns. But if you have an increase in the spendability, basically, for the bottom of the society, then you will clearly see it in consumption patterns straight away.
The all-important question out for investors is, if we're going to get the fiscal impulse, how quickly do you think that LEGARDE can get something? I'm not saying the sort of the end game of social redistribution, but that first bit, which is let's just spend more, because Draghi basically just said, I'm going to keep, I know he's out soon, but I'm going to keep buying forever, low rates, so you can spend what you want to as governments, just get on with it. What's the sort of time frame for this? Because obviously equity investors will be going 6 months, 9 months ahead of where we think it's going to start. Is LEGARDE going to take a while to get all this going, or is it going to be soon?
It's a slower process than thought by many. Even though we've had the first very early stories from Germany that they are softening on their constitutional stance of not spending anything, I think it will take years. And when I say years, probably 2, 3, 4 years at the very least. So I don't think this is a good short-term story at all.
So Europe probably needs a shock first, or put it this way, I don't want to be long the concept of Europe, apart from a few sweet spots, certainly not the banks, unless we get the shock that makes them move earlier. Otherwise, we've got to play a waiting game of maybe 4 or 5 years.
Yeah, I think the economy needs to deteriorate further before we really have a green signal for that story.
So where would you be putting your money then? So many assets are excessive. Would you be looking at equity markets? Would you look, which areas would you look at? We talked about European high yield, but what else?
We've been kind of boring this year in the sense that we've just loved haven assets. So treasuries, precious metals, that kind of stuff. And it's worked out pretty well over the past couple of quarters. And I don't think we are at the peak of that story yet. We know that there is a very neat correlation between, for example, gold prices and the amount of negative yielding debt globally. And I don't really see a big game changer coming up for the amount of negative yielding global debt. So that's a good story for precious metals. People simply look for places to park something without a negative yield. And therefore, haven assets, treasuries, gold, silver.
With those yields, one of the big ones has been the real yield versus gold, and obviously real yields falling, gold going up. Do you see any inflation coming in Europe anytime soon to create a really big collapse in real yields back to maybe I'm talking about US real yields, but back to taper tantrum levels, which would be another driver? Or where do you see real yields going in both Europe and the US?
If you look at European spot inflation, at least in core terms, there is no movement at all. It basically looks like a dead patient, right? And I expect that to continue. If the Eurozone wasn't able to create any core inflation at all during the reflationary environment we had in 2017, why should it be able to in 2020? I simply don't see any reasons to be optimistic on the Eurozone's behalf in that sense. I think there is a slight risk and a growing risk that we will see some sort of stagflationary environment in the US over the next 6 months. We've already had signs that core inflation is actually picking up, and I think partly as a result of Trump's policy mix, while the economy is going south, at least in momentum terms. It's not that bad yet. So it looks kind of stagflationary to me over the next 6 months in the US. So I'm more bullish on inflation in the US compared to the Eurozone, definitely.
And could we get an outside move from bonds? Because we had this fantastic move in bond yields down to, we got to 140 on the US 10-year, I think backed up to 180, again, speaking on the Friday after the ECB. But does this work in reverse? So if we get stagflation and real signs of, even if it's transitory inflation, could we get a much bigger move in bond yields, reversing some of these mechanical factors that cause bond yields to fall to such low levels? So is there a risk that we suddenly get this shock? I'm not going to say it's a VAR shock, but a shock in bonds selling off based on that scenario.
I think if we look back at what happened in the spring of 2015 in the Eurozone, it was definitely a big move we saw in bond yields after the ECB announced the QE program. I think it was sparked by excessive positioning. And I think there are kind of signs in that direction again this time around. But the big difference is that the world economy is in a much worse state than it was in 2015, as far as I can see right now. And therefore, I see a much smaller risk of that sudden implosion in bond markets with basically 100 basis points move in 10-year bond yields overnight, more or less. I don't see a big risk of that due to the fact that the economy is in a worse state.
And do you think that China, I mean, China doesn't seem to want to put its liquidity to work at the sort of growth at any cost. It seems to be much more targeted liquidity. But could China's liquidity change that? And or everyone talks about the trade spat between China and the US weighing on sentiment. So although it's not had a massive impact on trade numbers, it's having an impact on the psychology of the market. Do you think if any of those two came around, they could trigger something quite significant?
I think what's important to note around the trade war, first of all, I don't think it's a trade war, it's a Cold War, at least an emerging Cold War, is that Trump has put a target on his Fed funds view now. It's 0% or lower, because that's what's happening elsewhere in the world. And I don't think he will change his direction on the trade war one single bit before he gets the Fed to cave in first. So that's sort of a prerequisite for a deal being struck between US and China. So I think he needs the Fed to cave in completely before he wants to sign anything. And therefore we need to see Treasury yields lower before that scenario unfolds.
But if let's say Trump gets what he wants and he cuts, and the Fed accidentally cuts rates down to zero, the assumption that most people have on the back of that is, well, that means the dollar goes down. But wouldn't that actually encourage more money into the US?
Yes.
Because you'd be chasing bonds now are rocketing to zero yield, and therefore the capital gains will be huge. Wouldn't that just be actually counterproductive, because it will make the US even more exciting relative to the rest of the world, which has been struggling? And you might get a small blip down on the dollar, but won't that just pump liquidity back into the US from foreign investors?
Yes, I think so. And that's one part of the equation that Trump definitely hasn't understood, that him pushing forward with his trade agenda is something that's positive for the dollar. So all of his moaning about the strong dollar, he basically worsens the situation for himself as long as he pushes forward with his agenda on trade, because the dollar is standing strong in such an environment, definitely.
Let's just kind of round this out with let's take a 6-month view.
Yeah.
I mean, this next quarter, the next 4 months, they're always a big 4 months going into the end of the year. How do you see this playing out? I mean, what would be your sort of most likely scenario, and then maybe what would be your tail kind of event? So most likely scenario, and then what do you think might be the surprise?
My base case is that we will get a rebound in the global economy by April next year. So before that, we're going south still. And I have a base case of a sell-off in equity markets in Q4. For some reason, it's always in Q4. And I think the withdrawal of dollar liquidity due to the US Treasury building up its cash buffer again will be the trigger of that sell-off. So a dollar liquidity removal will be bad news for risk appetite in general. So therefore, my base case is just to just stay long safe haven assets for the next 4 or 5 months. And then that could be the trigger of that soft QE4. Maybe it's too early to expect it by late this year, but maybe in Q1 next year, after we've seen this risk-off environment, then the Fed could inject liquidity again, and maybe we are back to hallelujah, at least for some time being.
Big risk being funding is that event that we really need to watch for, because we can all see the slowdown in manufacturing. Probably everyone's positioned for that. But the funding is still something which could catch us out. We expect the Fed to have our backs, but they may be a bit slow on it.
Yes, too slow. That's my base case.
And therefore you'd stay short, or you wouldn't want to go long all those which are like the European banks, which care and need dollar funding, and emerging markets and all that. So it's stay with the US, stay with, as you say, the dull stuff.
Yeah, but as soon as Jay Powell pushes the button on QE4, then I will turn around.
So there's hope. There's hope in the medium term. Great. Well, great to have you on. Thank you very much for that. I was expecting it to be sort of, kind of almost think it'd be worse outlook, but actually there's some positives in there. And if the Fed are preemptive, then actually we might get something earlier. So that's something to maybe look forward to.
Yeah.
Great. Well, great to have you on for the first time, and hopefully we'll have you back sometime soon. Thanks a lot. Good to see you.
Likewise.